A growing number of high-profile voices are raising alarms that the artificial intelligence sector may be inflating into a major financial bubble. Concerns are widespread enough that it's worth examining the risks, the potential severity of a downturn, and how forward-thinking investors can protect themselves while positioning for long-term success. Time is valuable, so it makes sense to dive into the core ideas right away. It has recently been argued that investor enthusiasm surrounding AI has hit unsustainable levels. Some industry leaders have compared today's excitement to the mania of the late 1990s dot-com era, when internet-related companies soared on speculation rather than fundamentals. In that period, stock valuations ballooned far beyond what revenues or profits could justify, and when reality caught up to expectations, many companies collapsed, taking the market down with them. The tech-heavy NASDAQ famously lost around 80% of its value as countless unprofitable startups failed to deliver. Warnings have not only come from CEOs, but also from academics and well-known investors. Scholars of business and finance say that today's AI fervor could leave even more financial casualties than the dot-com crash did, particularly among companies viewed as poster children of the AI movement. Some argue that investors are confusing excitement for the technology with rational reasons to invest. In addition to those broader market concerns, research from institutions such as MIT has revealed something troubling. While nearly every large company is piloting AI initiatives, an overwhelming majority, reportedly around 95%, are not seeing meaningful outcomes yet. So while corporations are eager to adopt AI, the real return on those investments often hasn't materialized. On top of general warnings, critics have called out specific companies whose valuations appear detached from their financial reality. For instance, some analysts have suggested that if a prominent AI-focused software company were valued using the same market metrics as the largest private leaders in the space, its fair price would be drastically lower, perhaps even more than 70% below where it trades today. As broader technology stocks fluctuate and as certain AI names suffer noticeable pullbacks, these comments gain traction in the press. Given all of this noise, it's natural for investors to wonder whether the AI sector as a whole is heading toward disaster. But while general fear may make headlines, a deeper, more data-driven look paints a more nuanced picture. A quick summary of one rational viewpoint is this. Yes, parts of the market are currently overvalued, but the bubble is not as widespread or as fragile as some commentators suggest. Using emotion is the wrong approach to investing. Instead, it is better to evaluate financial strength, technological moats, and growth momentum to determine where true value resides and where speculation dominates. A more sensible way to analyze today's situation is to compare it with past technology revolutions. Many people instinctively look to the early internet era as the closest analogy, but there are critical differences that make the comparison flawed. For example, during the dot-com surge, most of the companies drawing big investment dollars had no real business models and minimal revenue. Launching a website required only modest resources, which contributed to an explosion of weak startups chasing hype without any infrastructure to support long-term productivity. There was far more supply of internet-based ideas than demand for those products, especially because consumers weren't yet accustomed to online shopping and broadband penetration was still tiny. The AI industry today is structurally different. The leading companies are not hopeful startups, but massive enterprises with billions in revenue, substantial profits, and wide operating margins. In addition, designing competitive AI systems requires enormous capital. Not simply a bright idea in a web domain. The computational infrastructure needed for training advanced models costs millions to billions of dollars. Consumers are also already digitally connected and eager to integrate AI into daily life through services, apps, and devices they already use. As a result, AI demand at the application level is running ahead of supply, not lagging behind it as the dot-com market once did. Because of that, a more accurate comparison may be the rise of the mobile internet era. When smartphones emerged, people were already online, already using digital applications, and already spending real money through technology platforms. The infrastructure needed to power mobile apps, chips, networking, cloud servers, existed first, and then software innovations followed. Today's AI momentum is following a similar pattern. The foundational hardware layer is expanding rapidly, followed by data center infrastructure, followed by a wave of emerging software solutions. To dive deeper into what is actually overheated in today's market, it helps to classify AI-related companies into three distinct categories. First are the semiconductor firms that build the computation engines powering AI. Second are the infrastructure companies that create cloud data centers and devices needed to deploy AI at scale. Third are the software and services companies that attempt to monetize AI through applications. Historically, the earliest phases of major tech waves tend to reward hardware producers first, then infrastructure providers, before software companies finally achieve their full potential as the technology matures. With that framework in mind, one can evaluate whether those groups are being valued reasonably. Semiconductor producers, especially the market leaders, are reporting extraordinary revenue growth and expanding margins. Their biggest limitation is supply, not demand, which strongly suggests a real business foundation rather than hype. The same goes for major cloud providers. Even while investing huge sums in a new data center capacity, many of them are still growing revenue near 30% annually. Their customers are actively paying for services, not merely experimenting with them. This makes the third category, pure software companies branding themselves as AI enterprises, the most susceptible to bubble-like pricing today. Their price-to-sales ratios often tower above those of foundational players, even though they produce a fraction of the revenue and grow at a slower pace. Some of them may indeed become extremely profitable in the long run, but their valuations are implying years of success before the business results have arrived. A big reason for the valuation tension is timing. The most transformative AI applications might not yet be publicly tradable. Unlike in the early 2000s, today's most promising technology startups wait far longer before going public, sometimes a decade or more. By the time they reach stock exchanges, much of their rapid early growth phase has already rewarded private investors instead of the everyday trader. To address the worst-case scenario, if a serious market bubble is indeed forming, we can turn to historical performance for guidance. Analysts have studied decades of bull and bear markets. A bear market is defined as a decline of 20% or more from a peak. On average, bear markets are relatively brief, often lasting about a year, with markets dropping around 36% before bottoming out. Recovery to a new high usually takes around 2 additional years. While living through those declines is emotionally challenging, the overall timeline is shorter than many fear, especially when considering decades-long investment horizons. In contrast, bull markets are longer, stronger, and more frequent. They typically last more than 6 years and generate returns exceeding 200% on average. Even the harshest downturns in history, such as the global financial crisis or the tech collapse of the early 2000s, were followed by enormous recovery periods where the market surged to new records. Shorter pullbacks are also common. A market correction, defined as a 10 to 20% drop, happens roughly once every few years. Historically, they take only a few months to reach bottom and only a few more to recover. Markets may experience multiple pullbacks within a single year, but despite volatility, the long-term trajectory has always been upward. What does all of that mean for AI investing? It suggests that while valuations may fluctuate, technology leaders with real profitability and demand are positioned to succeed over time. The hardware and infrastructure companies enabling the AI revolution have demonstrated tangible growth today, and they form the foundation upon which future software profits will be built. Companies selling AI services may need more time for their revenue to catch up to expectations, which means their prices may cool before rising again over the long term. Based on this perspective, a practical strategy does not require drastic shifts. A long-term investor could choose to move more gradually, adding to positions at a measured pace rather than rushing in when prices spike. Keeping extra cash available allows taking advantage of future buying opportunities during corrections. Emphasizing financially strong semiconductor manufacturers and major cloud computing providers offers stability while retaining exposure to AI's biggest structural growth drivers. Innovation-focused software names can remain part of a portfolio too, but allocated at levels that reflect their current risk-reward imbalance. What matters most is focusing on the long arc of technological progress rather than short-term hype. Bubbles form only when excitement vastly outweighs economic fundamentals. And in several key parts of today's AI sector, fundamentals are not only real but accelerating. Over shorter windows, volatility is inevitable. But history shows that those who remain invested in transformative technologies through both downturns and recoveries are often rewarded far more than those who try to time every fluctuation. Investing in emerging technology requires balancing caution with conviction. The AI revolution is undeniably underway, and world-changing products and platforms are being created in real time. Some companies are overvalued today, and there will be shakeouts as the industry matures. Yet the underlying demand for computation, automation, and intelligent systems suggests that even a major correction wouldn't permanently derail progress. Those who approach this era with thoughtful strategy and patience are likely to benefit from one of the most important technological shifts in history. That was all from us today for this video, folks. For more similar content, make sure to subscribe to the channel. See you in the next one. See you in the next